Hello, friends. Today we are going to talk about one of the great companies, which is known as PTL Enterprises Limited. So before we go there, so here is a recap of our recent recommendations and their performance. The performance is as on the 14th of May 2021. So you can see that most of our recommendations have performed very well, giving anywhere between 10 to 165% returns in the period of 6 months. So you can subscribe to our products at https indiastockanalysis.com and take advantage of our expertise in identifying undervalued stocks poised for good growth in future. Okay, let us briefly explain our approach in identifying great Indian companies. We screen and eliminate companies whose sales are falling, which are loss-making, whose operating and net profit margins are negative, companies that do not pay any dividends, and which do not generate cash, and those that have excessive debt in their balance sheet. So after these companies are screened and eliminated, we assign ratings to the remaining companies based on several parameters such as sales growth, profit growth, dividend yield, return on equity, debt to equity, earnings yield, return on invested capital, and other factors. So after we rate the companies from the above, we recommend the top 20 best rated companies every week. So our recommendations are weekly, so with a target price for 1 year and 3 years. Our recommended maximum price to pay includes a margin of safety of 40%. We don't want our subscribers to lose their investments, so therefore we have built in a margin of safety of 40% into our recommended prices. And our aim is to earn a minimum of 20% compounded return per annum. Now let's talk about PTL Enterprises. Its ticker code is 509220. It's in tires and leasing. We'll talk about why we have tires and leasing there, but it's mostly into leasing. So the current market price is 47 as of the time of making this video. The company website is ptlenterprise.com, and it has an overall India stock analysis ISA rating of 88 out of 100. Now about this company, it is headquartered in Cochin, Kerala, and this company commenced production in 1962. It used to have a tire manufacturing facility in Kerala, but then this facility was acquired by Apollo Tires in 1995. So ever since then, the company has leased its manufacturing facility to Apollo Tires, and recently the lease was extended till 2030. So that is, this company would get revenues until 2030, and the revenues are very certain until 2030. So PTL Enterprises, it gets a lease income of 60 crores every year from Apollo Tires. So Apollo Tires, as you know, is the global leader in tires, and it has both Indian as well as global presence. It's a market leader, we can say, sort of in tire manufacturing. So it gets 60 crore every year from Apollo Tires for leasing out its manufacturing facility, including land. So this is its primary source of income. So the 97% of the revenue is generated in the form of lease income that it gets from Apollo Tires. Now the governor of Kerala and the Kerala State Industrial Development Corporation, they hold 88% of PTL's shares. And another interesting thing is that PTL Enterprises also holds 3 million shares in Apollo Tires. So that was a brief about this company. Now let's see, why did we pick this company up for analysis? Now, why do we like this company? Because it's a professionally managed company. Mr. Onkar Kanwar, the chairman of Apollo Tyres, is also the chairman of PTL Enterprises. And he has been awarded Ernst & Young Entrepreneur of the Year Award and is also awarded the Order of the Rising Sun Gold and Silver Star Award by the government of Japan. And he holds a degree from University of California. Another reason why we like this company is that it has a history of uninterrupted dividend payments for the past 8 years, and it has been consistently increasing its dividends in the last 5 years. And the company has, and in 2020-21, the company has received a compensation of 29 crores for the sale of land from the government of Kerala. So this is a totally additional income that the company has received in 2020-21 from government of Kerala for a sale of land. Now the company has a stable source of income. Now the source cannot become more stable than this because it gets lease rentals from Apollo Tyres amounting to 60 crores every year, and this lease has been extended until 2030. So its source of income is quite stable. And it also gets dividends on the 3 million shares it holds in Apollo Tyres. Apollo Tyres is a global player in tire manufacturing with facilities in India and abroad. Growth in the automotive sector, especially driven by electric cars and for Apollo Tyres, directly helps PTL Enterprises by increasing the market value of the investments that it holds in Apollo Tyres and also the dividends it receives from Apollo Tyres. Now, PTL Enterprises is a completely debt-free company with a cash of around 45 crore on its balance sheet. Now, here are some of the important financial ratios. Its current price is 47.25. It has an overall India stock analysis rating of 88%. Well, since its only source of income is the lease rentals that it gets from Apollo Tyres, there hasn't been a much of sales growth in the last 5 years. It is pretty stable. And the profit growth has been around 13.68% because it has been able to control some of its costs. So the earnings per share for 2020-21 was 10.58. And since it is going at 47, that makes a PE of less than 5, which is quite attractive. And its operating profit margins are 90% because the only source of income that it gets is from. So there's not a lot of management that needs to be done, not a lot of expenses that need to be incurred by the lessee, which is the PTL Enterprises here. So therefore, the operating margins are pretty high. It is 90%, and the net profit margin is 73%. And it has a very high dividend yield of 10.58%. The average return on equity has been under 10, and the debt to equity is 0. It's virtually it's a debt-free company, and it has a cash and balance sheet of about 45 crore. Now let's come to the targets and the recommendations. So based on the above analysis, here are our targets for 1 and 3 years. So our recommendations aim to earn a return of at least 25% on your investments per annum without considering the dividends. Now the maximum price to pay, as I said earlier, contains a margin of safety of 40%. That is, the maximum price to pay is designed in such a way that you would be paying only 60 paise for a share that would be quoting at ₹1 after 1 or 3 years. So it has sufficient cushion if the things do not turn out the way we expect them to. So based on this, the 1-year target is 57 for this stock. And we recommend that you do not pay anything more than 33 for this. Similarly, the 3-year target for the stock is 66. And we recommend that you pay we recommend that the maximum price to pay for a 3-year target is 34. So at the current price, this is slightly overrated, overvalued. So you can add this stock to your watch list. And when it reaches the appropriate price as indicated here, then you can start buying this company. I mean, you can buy the company even now, but the returns that you would get based on our targets wouldn't be very substantial. Okay, then thanks for listening. So we'll be back with a video of another company shortly. Have a good day. Bye.